The SEBI has introduced a significant regulatory shift to fundamentally change how ESOPs held by founders are treated in the context of IPOs. This long-awaited move brings much-needed clarity, especially for promoters of high-growth companies who have faced regulatory uncertainty that led to the cancellation of stock options held by promoters or directors prior to listing. For context, the company's share capital and debenture rules and the SEBI share-based employee benefits and sweat equity regulations provide the primary regulatory framework governing the grant of ESOPs to employees in both unlisted and listed companies. Both frameworks exclude promoters and members of the promoter group from the definition of employee and therefore make them ineligible to receive ESOPs. Now, the term promoter is broadly defined. It means a person who has either been named as such in a prospectus or is identified by the company in its annual return, or someone who has control over the affairs of the company, whether directly or indirectly, or in accordance with whose advice, directions, or instructions the board of directors of a company is accustomed to act. Now, until now, there was significant uncertainty around whether stock options held by founders previously could survive post-IPO, particularly if these were granted prior to the date of filing of the draft red herring prospectus or the DRHP, and if they were to be named as promoters when filing the DRHP. Since the SEBI ICDR regulations did not explicitly outline what would happen with them, companies and merchant bankers took a conservative approach, cancelling such options before filing the DRHP for fear of regulatory pushback. Now, this led to value erosion for promoters, disincentivized long-term alignment, and reinforced the stereotype that Indian regulations had not yet embraced realities affecting the startup and new age economy. So, in July 2024, SEBI issued a consultation paper proposing that vested ESOPs held by promoters or directors prior to DRHP filing should be allowed to subsist post-listing, subject to disclosure and lock-in requirements. And now, SEBI has amended the ICDR regulations to formalize this proposal. Effectively, ESOPs now granted to founders at least 1 year prior to DRHP filing, whether vested or unvested, can continue post-listing even if they are classified as a promoter in the filing documents. These options will be subject to the standard lock-in applicable to promoters under SEBI rules, which is typically 1 year post-listing for pre-issue shareholding. And a full disclosure of the terms and conditions, vesting schedule, and exercise price must be made in the DRHP. This move brings India closer to global best practices where founders and key management personnel are incentivized through long-term equity compensation even post-IPO. And this particularly matters because promoter-led companies often forego salaries or dividends in early years and rely on stock options as a long-term wealth creation tool. Cancelling those ESOPs right before a listing not only demotivated founders, but also made Indian equity markets less competitive globally. SEBI's move ensures regulatory clarity, promotes long-term alignment, and incentivizes founders to stay invested in their companies post-listing, something we see as being critical to startup IPOs on Indian exchanges.